Everyone talks about putting 20% down as the golden rule of buying a home. But in all reality, who has 20% to put down? Well, the good news is you don't need anywhere near that much. Today, we're breaking down exactly how much home you can afford if you just put 3.5% down. In addition to that, we'll discuss whether or not it's a smart move. But before we get into that, I have a question for you. If you had to choose, would you rather wait and save 20% down or buy sooner with less money? Do me a favor and drop your thoughts in the comments below. Most people who buy a home with 3.5% down are using an FHA loan because they allow low down payments, in addition to being the most lenient loan program out there when it comes to your debt to income, which essentially translates into using an FHA loan will allow you to buy more home than any other loan program out there when it comes to how much debt you have versus how much income you make. But with that said, there is a trade-off. With the first being you're financing a higher amount. When you put less money down, you're essentially financing a higher loan balance, which in turn is going to mean higher monthly payments, in addition to having both upfront mortgage insurance as well as monthly mortgage insurance, which adds to the overall cost of the loan. So is it worth it? Well, let's take a minute and actually break it down. As I mentioned a moment ago, a lower down payment equals a higher loan amount, which equals a bigger monthly payment. Let's do a quick example here of buying a home with 3.5% down versus buying a home with 20% down, just for a little context. And in this example, we're going to use a $400,000 home. So if we're buying a home using an FHA loan and putting 3.5% down, that's essentially a $14,000 down payment. And as I mentioned a moment ago, FHA loans have upfront mortgage insurance of 1.75%, which means we're actually going to be financing $392,755 is our base loan amount. Whereas when you're putting 20% down on a $400,000 home, that's an $80,000 down payment versus the $14,000 we mentioned earlier. But the trade-off is you're only financing $320,000, which means you're financing a lower monthly balance. You're not going to have mortgage insurance because you're putting at least 20% down, which in turn is going to translate into a lower monthly mortgage payment, which in this example here is going to translate into about $450 in savings by doing the 20% down versus the 3.5% down. So you're saving a considerable amount per month, but it's also costing you $66,000 more in order to do that loan, which, as we discussed at the beginning of this video, most people don't have that additional money. So what I want to do now is actually break down the numbers and tell you how much you can afford if you're just putting 3.5% down. Now, before we do that, there's one thing that we need to understand in order to figure out this affordability factor, if you will, and it's how lenders calculate how much home you can actually afford. It goes back to that debt to income ratio that we mentioned earlier, which is essentially your monthly debts versus how much income you make. So in order to calculate this, we need to figure out how much money we bring home on a monthly basis. We're going to say you make $65,000 a year, and the reason we're using $65,000 a year is because it's the average salary here in the United States. Now, the thing that most people get confused on when trying to figure out this calculation is that they're using the calculation based off how much they actually take home, their net pay, when lenders are going to use your gross monthly income. It's the amount that you pay before any taxes come out. So if you make $65,000 with your employer, chances are you're not bringing $65,000 home. You're bringing home less money because you're paying into taxes and Social Security and 401k, so on and so forth. But here's the thing, the lender isn't counting that. They're using the amount that you make before taxes come out. So in the example of $65,000, we divide that by 12, which gives us a gross monthly income of $5,417 per month. So that's essentially our income part of the equation. Now, the debt part of the equation is a little bit harder to calculate. When lenders are looking at your debt, they have something called a front-end ratio and a back-end ratio. And the front-end ratio is going to be your proposed housing expenses. How much is the house that you're looking at buying going to cost you on a monthly basis? That takes into account the principal, the interest, the property taxes, the insurance, if there's mortgage insurance on that loan as well as homeowners insurance, HOA. It factors in everything. That's essentially going to be part of your front-end ratio. What they do is they take that amount and they divide it by that gross monthly income that we mentioned earlier. But the other part of that equation is your back-end ratio. So as I mentioned, there's a front-end ratio, there's a back-end ratio. The back-end ratio takes into account those proposed housing expenses that we mentioned earlier, but it also takes into account the things that show up on your credit report, your car payment, your credit card, your student loans, any sort of installment debt, the money that you spent when you bought furniture for your new house. All of that is taken into account account. What's not factored in there is how much you spend on groceries, your cell phone bill, childcare, date night, all of that other stuff. That should go into your budget, but it's not factored in how the lender determines how much home you can actually afford. So as I mentioned earlier in the video, FHA is the most lenient when it comes to your debt to income ratio. And that's because they allow you to finance more than conventional loans, which in the case of FHA, they allow you to have as high as a 47% front end ratio with as high as a 57% on the back end. So let's use the example that you're buying a $350,000 home today using an FHA loan, and let's just say rates are at 7%. Well, that basically means that after the upfront mortgage insurance, you're going to end up financing somewhere around $343,660. Which means the mortgage payment financed at 7% is going to be $2,286 per month. On top of that, you're going to have property taxes. The nationwide average for property taxes is 1.1%. But understand that different areas of the country, even different areas within the same state, have different property taxes. And this is one of those things that can change considerably depending on where you are in the country. So just make sure you're using the amount for the location that you're looking to buy in and not just assuming the 1.1% average. But for purposes of this video, we're going to use the nationwide average, which means our property taxes are going to be $321 per month. On top of that, you're going to have the monthly mortgage insurance that FHA requires, which is 0.55%. So in the case that we're financing $343,660, that mortgage insurance works out to be $157.51 per month. On top of that, you're going to have homeowner's insurance, which covers fire, theft, that sort of thing. We're going to estimate it at around $150 per month, which means buying that $350,000 home with just 3.5% down is going to give you a payment somewhere around $2,914 per month. So the question is, can you afford it if you make just $65,000 per year? Well, let's take a look at that debt to income ratio that I mentioned earlier. FHA allows you as high as a 47% on the front end. So in order to calculate this, we're going to take your $65,000 salary, as we did earlier, we're going to divide it by 12, which is going to give us $5,416 a month in income. As I mentioned earlier, the mortgage payment associated with this $350,000 home is $2,914 per month. So we're going to take that, we're going to divide it into our gross monthly income, which is $5,416, which works out to be 0.54 or 54%. Now, if you remember from just a minute ago, we said the highest we could go on the front end ratio is 47%. So we can't buy a $350,000 home if we make just $65,000 a year in income, because in this case, we didn't even take into account any monthly debts that you might have in addition to those housing expenses. Now, before we answer the question of whether or not it's a smart move, I want to take a minute here and put some numbers on the screen working through different purchase prices and the salaries that are required in order to buy those homes. Now, for these numbers, I'm using the exact same calculations that I used earlier. I'm using that 7% interest rate. I'm using all the other same factors just so we're very, very clear on how we're getting to these numbers. Now, one thing to understand about what I'm going to throw on the screen here is that I'm breaking down how much you can qualify for using that 47% front end ratio of incomes ranging from $50,000 per year to $1 million per year. In addition to that, you can also see what the housing payment looks like for those homes ranging from $150,000 up to $700,000. So you can do the same calculations to figure out whether or not you could actually afford that home. But here's what I like to say when doing videos like this. This video is for novelty purposes. Don't do this at home and take it and just run with it. Make sure you're working with a professional. Have them going over the numbers, using that day's mortgage rates, looking at your income, your credit score, all of those things, just to make sure you're doing the right calculation. Because the last thing you want to do is use my calculations, go out and put an offer on a home, and then you don't end up qualifying. So if you think you're ready to start the process, you're ready to get pre-approved, do me a favor and go to that link in the description of this video, jebsmith.net/start, where you can start that stress-free pre-approval process today. So the question is, buying a home with 3.5% down, is it a smart move? Do me a favor and let me know in the comments. But here's my take on it. I believe it is a smart move if, for one, you don't want to wait years to save up for a larger down payment. Most people think they need a larger down payment in order to buy a home. I just showed you that you don't have to have 20% down. You can buy a home with as little as 3.5% down. The problem for most people is they can't save fast enough to keep up with the rate of appreciation in property. So while they're saving money, the home price of the property that they're looking at is just getting higher and higher and further out of reach. So the earlier you can buy that home, the earlier that you can essentially fix your housing costs and not get caught in the trap of renting for your entire life, where the landlord is essentially controlling how much money you spend every month on your housing costs. It can also be a smart move if you have financial stability, if you have relationship stability, if you're at the right time in your life to own a home and you have that longer term time horizon. If you think you're going to be in that property for more than 5 years and you meet all the other requirements, then I think buying a home is the right choice for the majority of people out there. Now, it's not for everyone, and I'm not pushing you to go out and buy a home, but at the end of the day, you have to put a roof over your head. So your options are either renting or creating a plan to buy a house at some point in the future. But here's the thing, it could be a really dumb move to buy this house, even with as little as 3.5% down, if you're already stretched thin. If you don't have money in the bank, and the only way you're buying this home is with the idea that at some point rates are going to go down and you're going to be able to afford it because you're going to refinance, then buying a home probably isn't the right choice. At the same time, if you're somebody that's only going to plan on owning that home for 1 to 2 years, you plan on moving out of the area, or maybe you don't have job stability or relationship stability or financial stability at all, you have no other money outside of your down payment and closing costs, then I would suggest holding off until you have some of these pieces of the puzzle ready. On top of that, FHA loans allow you to buy a home with 3.5% down with a credit score as low as 580. But I want to say something shocking right now. You shouldn't be buying a home if your credit score is 580. You should rather be focusing on trying to improve your credit score before pulling the trigger on buying a home. A higher credit score is going to give you much more favorable terms, which in turn is going to translate into a lower monthly mortgage payment. It's also going to allow you to qualify for more homes. In fact, your credit is the most important part of the equation. So rather than rushing into the process to try to buy a home, focus on the things that you can control. Your credit score, your down payment, your reserves, all of those things matter. And lastly, I want to touch on one thing that I hear a lot, and that's that you shouldn't do an FHA loan, that you're essentially throwing money away because you have mortgage insurance and you shouldn't be buying a home unless you have 20% down. But here's the thing, waiting is likely going to end up costing you more down the road. As I mentioned earlier, most people can't save quickly enough to keep up with the rate of appreciation in home prices. So by waiting, home prices are likely going to continue to rise, which means the home that you want is going to get more and more expensive. On top of that, renting isn't free. Every single month that you pay rent could ultimately go to building equity in your own home. But at the end of the day, you have to do what's right for you. So if you're ready, you're financially stable, and you're comfortable with the monthly mortgage payment, buying now with 3.5% down could be a great option. So if you think you're ready to start the process or want to see where you stand, do me a favor and check that link in the description of the video. And the other thing I will say is if the payment stretches you too thin with just putting 3.5% down, then my advice is to keep saving. But also assume that waiting isn't necessarily going to make home ownership any easier. Now, if you found any value in today's video, do me a favor and hit that thumbs up. And if you like content and want to stay updated on everything mortgage and real estate related, do me a favor and subscribe to the channel. The last thing I want to ask is, now that you have an understanding of FHA loans and what it requires, would you buy a home with just 3.5% down? Or do you think holding out for a bigger down payment is the right move? Do me a favor and drop a comment below.